Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking some time out of your busy day, perhaps shoveling snow and digging out of this winter storm you've been having, and spending some time with us. As we say often on this show, and as most of our frequent viewers know, this show was created to basically answer as many questions as we can from individual investors, questions about their investments, portfolios, the economy, what's going on in the world. And I feel today's show is a perfect example of that. A lot of the questions I've been receiving over the last couple of weeks, we're going to try and answer those questions today. A lot of questions about tariffs and the economy and what's going on down in Washington and around the world. And so wanted to answer those questions today and really provide some context as to what's happening, what you should be considering going forward as an investor, and what to focus on. So let's put up a summary of our topics today. There they are. Markets don't move in straight lines. Does today's investor face more volatility than the last 10 years or from 10 years ago when you compare? A lot of people will say, yes, we know markets don't move in straight lines, but you'd be surprised how many investors call me when there is a bit of a pullback in the markets, wondering if they should be sellers at this time. So yes, even though we know markets don't go straight up forever, investors still get a little bit jittery, a little bit nervous when we receive a pullback. Top 3 things to consider over the next 5 to 10 business days. As always, these are the things that I think individual investors should be focusing on before you go out and make a buy for your portfolio or a sell for your portfolio. With tariff threats, investors are wondering, should you be investing in the United States? Getting a lot of questions about that. Should we be investing still in the US? Obviously, our currency is a lot weaker than the US currency right now, than the US dollar. That also plays a factor as well. So should we try to stay out of the US because of the tariff situation and the weak currency? Or should we continue to invest abroad and within our neighbors to the south in the United States? Are the Magnificent Seven struggling a little bit right now? We know the Magnificent Seven, the big cap tech names like Amazon and Apple and Microsoft and Nvidia and Tesla. How have they been performing? And what's going on with those names now? Do they continue to lead this market higher? We'll discuss that. Choosing an investment advisor. I can't tell you how many conversations I've had in the last, well, let's go out maybe a little longer, maybe the last month or two, about choosing an investment advisor. How should you choose an advisor? What types of questions you should be asking or what you should be thinking about? And I find it funny sometimes when individual investors go with an advisor that I would consider a little bit lower on the totem pole rather than that wealth management advisor, someone on the high end of that totem pole, someone who has a good breadth of knowledge with respect to the markets, stocks and bonds and mutual funds. Sometimes investors tend to move to an advisor just can sell only a few things, maybe mutual funds or insurance or just GIC. So we'll talk a bit about that as well. And quick hits. These are 3 ideas that some of you may have seen in the news recently. We'll discuss them. We'll show a nice little illustration for each, and I'll give an opinion on those in a very quick way. And last but not least, your questions. If you have any questions during the course of the show, as I said, a lot of the questions we're going to be talking about, the topics we're going to be talking about, are actually questions from all of you, all of the viewers and listeners of the show. So if you have any questions during the show, please put them in the chat boxes. We'd love to answer them at the end of our show today. If not, we can answer them on our next show or over the next 2 weeks between shows. So please feel free to ask any questions you may have. So without further ado, let's now move forward with our topics and our show. So I wanted to talk about, in general, market volatility and this idea that markets don't move in straight lines. And as I said off the top of our show, everybody will tell you, yeah, we know that. We're knowledgeable enough to know the markets don't go straight up. We know there are a lot of ups and downs. But yet, when the market takes one of those downturns, I can't tell you how many emails, how many calls I get. Is this the start of something bigger? Should we be concerned? Is it time to get another little nervous, take some profit off the table, move into cash or gold or other types of investment ideas that tend to be somewhat defensive or a hedge against what the investor has been doing over the last little while? It's quite interesting. Last year, for example, one of the best years we've seen in the markets for the S&P 500, 2024, back in the springtime, we had a bit of a dip in the markets. And I probably had a half a dozen emails saying, is this something leading to something bigger? Should we be concerned and nervous? And I said, obviously, no. I think this is a blip on the way to bigger things down the road. And obviously, I was correct and we were correct. And the markets really took off in the summer and into the fall and towards the end of this past year. And the markets were fantastic. S&P 500 made over 20% return. TSX made just under 20% return. The NASDAQ almost 30% return. It was a fantastic year. But within the year itself, there were some ups and downs. And what I tend to tell people is these pullbacks or these ups and downs, especially the downs, we give them different names each time. And our first chart actually will show you a lot of the ups and downs. This is the S&P 500 over the last few months. Look at that chart. How many ups and downs do you see in that chart? Yet I will tell you that the S&P 500 for 2025, so just 6 weeks in, 7 weeks in, it's up actually 4% for the year so far. TSX and NASDAQ are up 3.5% for the year so far. If we can make 4% on the markets every 2 months, well, that's a fantastic return. You'd be making about 24% for this year once again. So even though it's a very choppy market and a lot of people may not feel good about what's going on, markets are higher. And don't forget that yes, this is going to be the type of year, in my opinion, that we're going to experience. We're going to experience times where we think things aren't really going anywhere. As I've said to many of you that have asked me, I'm anticipating a 10% return this year, plus or minus, if you're invested in equities or the stock market through mutual funds or individual stocks. Obviously, bonds will be a lot less, low risk bonds. But overall, if you're in the equity or stock market, yeah, I think you can expect somewhere around a 10% rate of return, which means you're going to be making less than 1% a month. Some months you might have a negative number. Some months you might have maybe 2-3%. January was a good start to the year. And it's interesting because it may not feel like things are going well because of the choppiness, but in the end of the year, I think you'll be pleasantly surprised. And what I was getting at before we showed this chart was we call the downtimes different names. Right now, we're calling them tariffs. Tariffs are causing this market to be really jittery and to perhaps pull back. But I can show you other times in history. Our next chart, we can go back to a time back in 2008, 2007, the S&P 500. There it is right there. We call that time the financial crisis. It's a market downturn. We're all saying, oh my goodness, what's going on? Similar to other market downturns, although this name was different. We called this the financial crisis back in 2008 and up until the beginning of 2009. And you can see what happened in 2009. Markets actually practically doubled for investors, for many investors. Our next S&P 500 chart will show you other downtimes that we had other names for. 2020, COVID times, right? Markets pull back because of the pandemic at that time. So once again, we had a good market. 2019 was great. 2020, pull back in the markets, only to see markets surge again after that. 2022, a little bit further right of that little blip there, as you can see on the chart. Well, that was interest rate increase was the culprit here to bring down the markets. Interest rates went higher because inflation went higher. So interest rates had to go higher to basically combat the higher inflation rate. So again, keep in mind all these different times, and these are big pullbacks in the market. We could talk about smaller pullbacks like DeepSeek. Some of you might, I guess, be familiar with that name. DeepSeek, a Chinese company, came out recently and said, well, hey, what do we need with these expensive chips and these, that NVIDIA is making right now? We could use old NVIDIA chips, use less energy, and still produce an AI system that can rival anybody out there, ChatGPT and all the other ones, Gemini and all the others. And this was a company out of China that says they're doing it for a fraction of the cost. So what happened? All the chip makers, NVIDIA, AMD, everybody associated with semiconductors around the world, they took a hit. Some of the other big businesses like, names like Microsoft and Google, they also were affected for a very short period of time because why would they be spending all this money, billions and billions of dollars, 80 billion, 75 billion over the next year? 100 billion is what Amazon's going to spend on AI, on these chips, Blackwell chips, for example, out of NVIDIA, when a small company in China could do the same thing at a fraction of the cost. So the market pulled back. So what was that pullback? I call it the DeepSeek pullback. That was the name of the company. That is the name of the company. So pullbacks have a name to it. And right now, I guess we're experiencing one, and that is called tariffs. But make no mistake about it. Whatever it is, markets go up, they go down. The good news for all of us as investors, they go up a lot longer than they go down. The downtimes tend to be short-lived and sharp. The upturns tend to be longer and they don't go up as fast. So as I've said on this show before, when markets go higher, they take the stairs up, but when they go down, they take the elevator down. And that's really how you want to look at it. Moving to, I guess, the idea that today that market volatility is a lot greater than maybe just 10 years ago. I think that is very true. And I think if you're an investor today, you need to be mindful of that, because if you're going to invest in the stock market, you have to understand that it is normal to see a 5 to 10 to 15, maybe even a 20% drop or gain in a very short period of time, depending on earnings or announcements by a company or something out of the White House or something out of the Federal Reserve or Bank of Canada. These can affect stocks in a very large way. First chart we have here is of a company called AMD, Advanced Micro Devices, and you can see the downturn that they saw in and around February the 4th. Why February the 4th? Well, that's when they reported earnings. They reported record profits, $7.7 billion in revenue, 24% increase year over year. Yet the stock went down by 10%. Looking at the numbers, yes, 9.8% was the number that the stock dropped by. And that's because going forward, the market wasn't too impressed about what they were saying, how much money they were going to make for the next 12 months. They weren't impressed by their data center predictions, how much money they're going to make from AI and their chips. And so AMD sold off. Second, I would say second largest chip maker, well behind NVIDIA, and reported good numbers, but just not good enough. And so maybe 10 years ago, 10, 15 years ago, stock would have fallen 2, 3, 5%. Today, AMD fell 10%. Our next chart is Merck. Merck experienced this month, and you can see it here by the chart, its biggest one-day decline in the history of the company. The stock actually fell just under 12%. And why did Merck fall? Well, their numbers didn't really impress when they came out also in and around February the 4th. But more importantly, the drug called Gardasil that they're sending, a vaccine that they sent to China, China is no longer buying at this point in time. They've definitely reduced their buying of this drug. And I guess, according to Merck, inventory levels have built up in China. And so Merck is not sending as much of the drug out there. And so, bam, stock fell 12%. As I said, the largest decline for this company in its history. On the flip side, recently we've seen tremendous success. Companies going up by 16%. One of the names is Intel. Yes, Intel, a name that a lot of us would say, Intel, wow, that's a blast from the past, a name from the past, not really doing an awful lot. Well, that is true, but as you can see here, this chart shows that literally overnight or in just 24 hours, stock went up by 16% because Broadcom and Taiwan Semiconductor are rumored to be buying this company, dividing it into two, and each company taking a piece of the business. So in one day, 16% to the upside. Super Microcomputer, our next chart. This is a name that, in our last chart for this segment, this is a name that basically they design performance computer systems and services. They work very closely with NVIDIA chips, and it's a name that's been on a tremendous roller coaster ride. They saw their stock price fall sharply when their accounting firm, their auditors, quit on them because they did not report their data in time for the regulators. And so when you have your data not reported on time and the company that's supposed to report quits, that does not bode well for the company. So we saw their stock price sell off by over 20% in a very short period of time. Well, what has happened recently? They have a new auditor, they have a new accounting firm, and they say they will be able to meet any regulations that have to be met for the company. And what happened? Stock went up, as you can see here, over 16% in a very short period of time. Once again, this is volatility, I believe, 10, 15 years ago, we never would have seen. Company stocks are moving tremendously. And I think a lot of it has to do with this idea that stock market is priced to perfection. There's a lot of information out there for individual investors to parse through, to have access to, either through social media, online. A lot of people, know somebody or are talking about stocks or individual investments or the economy. There's just a lot of things going on out there. Some of it true, some of it not true, and just difficult for individual investors to parse through. So what tends to happen is investors shoot and then ask questions later. So these big movements that I'm showing you, yes, they are very brief and quick, but then cooler heads prevail. And not that the companies snap back right away if it goes down, or if it goes up, comes right back down. But we tend to see a bit of a consolidation period once a stock moves. And of course, investors need to see and hear something to either make the stock go back up again if it's had a big fall. So volatility, in my opinion, is here, and it is here to stay. And it is a lot greater than what we saw years ago. And if you want to be in the stock market and hopefully be eligible to make those returns, 8, 9, 10% on a medium risk portfolio, moderate risk in the stock market, you have to be willing to take the ups and downs. There's just no doubt about that. And as I said, as investors, I think it's important for you to understand this before you move into the stock market in some capacity, whether through individual stocks or mutual funds. Now, many people's favorite part of our show, top 3 things that individual investors need to be mindful of, focus on before you make your investment decisions. And we have our usual 3 ideas. First one today, corporate earnings to watch. Now, if you're a Canadian investor, which many of you watching are, Canadian bank stocks make up a very large part of Canadian portfolios, right? Canadian investor portfolios. Well, Canadian bank stocks are going to report earnings coming up in the next week and a half. The big banks, right? Your top 6 are going to report. Maybe even more important to the stock market than the Canadian bank stocks, NVIDIA. Well, no longer the largest company in the world, or fighting for that crown at this point. But NVIDIA, one of the largest companies in the world, largest chip maker, semiconductor in the world, makes up such an important part of our markets. They're reporting earnings coming up. So we'll touch on that. Inflation, we're going to get inflation data. We're going to get an update to GDP data in Canada and the US. How will that affect what the Bank of Canada and the Federal Reserve do with respect to interest rates? Will they think about cutting rates in the US, or will they stay the course and stay on hold? Tariffs, the threat of tariffs, the uncertainty of tariffs. That's ramping up all around the world, with President Trump talking about reciprocal tariffs now on places like Europe and Asia, and obviously Canada and Mexico. The issues or the uncertainty is definitely starting to ramp up, and we'll talk about that. So let's move on with our first point, corporate earnings season. And as I said, very important for Canadian investors are our Canadian bank stocks. And if someone were to ask me, what do I anticipate coming out of the Canadian banks? I think I'm going to say pretty good earnings. A lot's going to depend on certain things, how much money banks are setting aside for bad debts. Does that continue to increase? We've seen it increase in the last few quarters. Will that come down? Will it stay the same? Net interest margin, that spread between what banks pay on things such as GICs, so money that is lent to the bank, versus what people pay on their loans, right? So what the bank is paying versus what it's taking in, that's spread. That's net interest margin. For the banks, we want to see that grow. How is lending? What's going on with lending in Canada? Now that interest rates have come down, are businesses borrowing more? Are people borrowing more to buy a home, to increase or grow their business? These are all the things that we're going to be looking for with Canadian banks. Our first chart here, Royal Bank of Canada, probably the best performer, them or CIBC. You can see it's kind of topped out here in that 170 area, hasn't really surged higher, and that makes sense, right? Royal Bank is at all-time highs. Stock trades in and around 12, 13 times earnings. I think at best fair value. Some would say maybe even slightly overvalued. With that HSBC acquisition, they're still bringing that business into the fold and reaping the rewards gradually of bringing the HSBC business under their wing. So I look for some really strong numbers out of Royal Bank. The question is how far or how high can the stock go? They pay dividends just over 3%, so nothing great. There are other banks that pay higher. Our next bank stock, for example, Bank of Nova Scotia, an example of a bank stock that actually pays a lot higher, a larger dividend, just under 6% dividend, 5.5%, 6% in dividends. And Bank of Nova Scotia, we want to hear from them how this restructuring is going. We can see that their stock surged recently towards the end of last year, but as of the new year, we've seen it in the first couple of months, stock price start to come down. And again, the dividend has started to increase. But Bank of Nova Scotia exiting a lot of businesses that they believe aren't as good quality. A lot of these are international businesses trying to move more into the US. And we'll get a report shortly on how that is going. Next bank, TD Bank. And I bring this up because a lot of people have been negative on TD Bank. And as many of you know, I'm a contrarian. So when everybody was more negative on TD, I've been a buyer of TD stock. And yes, it's fared my investors quite well, as you can see by this chart. TD Bank stock back into the mid-80s. It was down to the mid-70s in stock price. And today it is in the mid-80s, still producing a dividend over 5%. I think a good opportunity. I think TD still has room to run. We want to hear from them. They no longer are giving a forecast with respect to growth numbers. They've stopped doing that. CEO is stepping down sooner rather than later, which we know that has given a boost to the stock. We want to hear more about their issues in the US, their money laundering. We want to hear how they're faring, how their numbers look, and interest margins and all that. So TD Bank is an important name that I think we want to focus on. And we're going to focus on all the names, Bank of Montreal, CIBC, and National Bank. I think if you look at our top 5 banks, you would say CIBC, Royal have been the 2 best performers, followed by BMO, and then the laggards have been more TD and Scotiabank. If you want to include National, it's been a fantastic performer. Not as good as late, so maybe more in the BMO area. But overall, I'm looking for really good things out of the banks coming up. NVIDIA stock, let's put a chart on that. They're going to report towards the end of this month, next week. And very important, obviously, you can see NVIDIA stock is sort of being flat, moving sideways. On the far right-hand side, you've seen NVIDIA move from about $120 to $140. I guess investors are expecting a pretty good number out of NVIDIA next week. The DeepSeek scare, as I mentioned earlier, really that's all it was. It was a scare, and cooler heads have prevailed, and we've seen NVIDIA move back in. So overall, corporate earnings are going to heat up in the next week or so. Second topic I want people to focus on before they make their investment decisions are the inflation and the GDP updates. So let's talk about inflation. Our first chart shows inflation in Canada. We're going to see, well, we see that our Bank of Canada rate 3%. Latest report on inflation 1.9. Again, that rate getting the benefit of a GST holiday. Many believe that's going to creep up into the 2.5% range. Now that GST holiday is no longer. That ended on February the 15th. U.S. inflation is the number we're going to look at, and in particular, PCE, personal consumptions and expenditures. That is the preferred measure by the Fed, and in particular, core PCE. And this chart shows all the numbers that I think are actually very important. Core CPI, core PCE, core PPI, which is your wholesale prices, average hourly earnings, and the Fed's target, which is that 2% rate. And you can see here, average hourly earnings have been sort of flat for a little while. Core PPI has come down a little bit. Core CPI has moved higher in and around that 3.3% rate. But many believe that PCE, when it's reported next week, is going to show a number that's in and around 2.5%. So many people are happy for that. They believe that we're going to see the PCE number come in just right and maybe alleviate some pressure on the Fed to perhaps not want to increase interest rates. You know, we've talked about lowering rates. Many people are talking about the Fed increasing rates. So we don't want to hear about that. The next chart, GDP. This is GDP in Canada. We saw GDP for the month of November actually show a negative number. So we're all wondering what the December number will show. We think it's going to be a positive number. So we're not in jeopardy of having a negative quarter. As we know, 2 negative quarters back to back represents a recession. So hopefully November was just a blip to a bit of a better number in December. Next chart, US GDP. And we can see that it's been coming down a little bit. We had 3% in Q2, 3.1, so roughly flat Q3, but a drop in Q4 to 2.3%. So we'll have to see what we get as an update to that number. We're going to get an update on US GDP shortly. But again, PCE, inflation, a market mover. And why is it a market mover? Because it's going to give us some insights and give us some information that the Fed's going to use before they make their next investment rate, or sorry, interest rate decision, which will come up in March. And many people believe that the Fed will be on hold at least till June, whereas the Bank of Canada could continue to cut, which, as we talk about often, not good for our dollar versus the US dollar. But overall, we're going to keep one eye or both eyes on PCE and inflation and an update to the GDP numbers. Our third and final point that I think individual investors need to focus on is this whole conversation of tariffs. And we hear about it every day. As the President of the United States says quite often, tariffs, or now maybe even the words reciprocal tariffs, are his favorite words in the whole dictionary. He tends to talk about it quite often, but he tends to also change his mind quite often. You know, will we have tariffs put on Canadian goods at the end of this month? Once upon a time, we were given a 30-day reprieve as of the beginning of February. Well, you don't really hear about that much anymore. We've also heard about tariffs on steel and aluminum. Are those going to go through? Now we're hearing about reciprocal tariffs. So if someone tariffs the United States, then the United States will tariff them back. They're doing an investigation or some research into that, and we'll have some answers out of White House the beginning of April. So that's delayed even further. So we keep hearing about tariffs. And I guess in the last 24 hours, hearing about tariffs on semiconductors or chip makers, hearing tariffs on pharma goods and pharmaceuticals. So it's always changing. Deadlines are always changing. And we're just not sure how to parse through it. But important definitely for the stock market and individual investors. Our first chart here, U.S. tariffs. Tariff revenues are a small slice of the pie. You can see here the red shows customs duties, which is what another name for tariffs is. You can see how much it makes up of revenue for the U.S. government, a very small portion. We go to our next chart here. The impact of proposed tariffs on auto sales would be significant. You can see 2025, the base case for Canada and the U.S., how much they would have grown. That's the black bar there. Then if they put a 10% tariff, that's the gray, how much it would fall. And then a 25% tariff, you can see how much the automobile industry would be impacted by 25% tariffs. Both sides, on both sides of the border, keep that in mind. That's really important, both in Canada and the US. So overall, tariffs are going to affect things. The talk of tariffs has already affected things. As you know, Premier Ford on our show has said, it's already causing individual businesses to figure out, you know, what they need to do, where they should take their business. Should they move their business to the US so to avoid tariffs? A lot of this is already being parsed through, ideas spoken about. And as an individual investor, it's definitely something that you need to keep one eye on, perhaps both ears on going forward, because it definitely will affect the stock market. So with all this tariff talk, a lot of individual investors are asking me, Allan, should we still be investing in the US? I guess the quick answer is absolutely. If you're investing in a company that is domiciled in the US, has factories and business in the US, then they're not going to be affected by these tariffs, or at least not directly anyways. A lot of people have been asking me about, for example, automotive parts, Magna. Magna has a lot of facilities in the US. And if they're able to keep their US facilities separate from their Canadian facilities, then perhaps maybe Magna will be not as affected as many people think. Now, of course, the auto industry in general will be affected. And so indirectly, a name like Magna or Linamar will be affected amongst other companies that do business or are involved with business around the auto industry, manufacturing of many different things cross border to the US every day from Canada. So yes, it's going to affect things, but should you continue to invest in the US? Well, I think the next chart or graph really shows that the answer is yes. And this is a chart on US equities dominate the value of global stocks. And even if you can't see what it says on this chart, just look at the orange. The orange is the United States. That is how much they dominate the value of global stocks. That is 67%. So if you're not invested in the United States, look how much of this pie, if you will, of this circle, you're not going to be invested in. How can you not be investing in the largest economy in the world with over 20% of the world's wealth flowing through the United States borders each and every day? You're going to avoid investing in the United States? Now, some people are going to say, well, our dollar, right? If you have Canadian dollars, how do you invest in the US? You lose 30% right off the top. Maybe so. But when you sell that US stock and convert back to Canadian dollars, if that US versus Canadian dollars is somewhat stable, let's say, in 6 months from now, you sell and you move money back to Canadian dollars, and let's say US Canada currency is still at 70 cents, well, the money you lost when you bought, you'll make back when you sell pretty much. And so really you're looking for opportunity and you're looking for good quality investments, and many of them, some of the biggest names in the world, some of the biggest tech names, some of the biggest banks, some of the biggest manufacturing international companies reside and are domiciled in the United States. And I think you need to still be there, or at least consider being there and buying good quality investments. You want to look at our next chart. If you decided you didn't want to buy in the United States, well, you wouldn't be able to own a name like Meta or Facebook. I can tell you that Meta just set a record. I believe it's a record, modern day record. This stock has been up. Prior to yesterday, it was its first down day since the middle of January. As you can see here, what kind of a run it's been on. Stock was up 20 trading days in a row. You don't want to invest in the US? You can't invest in a name like Meta. Meta is at all-time highs right now, and people still believe that the value or that the stock is relatively cheap. A name like Palantir. I've been asked about Palantir Technologies. Palantir produces a software that helps big organizations and the United States government in particular analyze data that's coming in from all different places. It's able to bring in this data, analyze it, make sense out of it, and be able to give you an action plan based on this data. And as I said, Palantir had fantastic earnings. Now, those of you that are asking, should we be buying Palantir? It's extremely expensive, trades at well over 100 times earnings, yet the stock continues to go higher. Perhaps you can't measure Palantir on an earnings per share basis, but overall, I would definitely not say Palantir is cheap. And as you can see by the stock price, it continues to move a lot higher. So should you be invested in the United States? The answer is yes. There's going to be a lot of talk and continued talk about tariffs, reciprocal tariffs, tariffs on many different areas. But at the end of the day, until the president signs these tariffs into order, until we get a definitive answer on what is being tariffed, how much is being tariffed, are there any carve-outs for certain industries or carve-outs for certain companies, we're just going to continue to stay the course. And to stay the course, in my opinion, to grow a portfolio, to grow your wealth over time, you need to be invested outside of Canada. And what better place to be than invested in the United States. So are the Mag 7 struggling a little bit? I'm going to say no. Some people would say yes. I'm going to say no. And here your magnificent seven are Alphabet, Amazon, Apple, Meta, formerly Facebook, Alphabet, formerly Google, Microsoft, Nvidia, and Tesla, for those of you who may have forgotten. Biggest companies in the world. Most of them are tech. You can call Tesla tech, or you can call it a car company. Amazon, you could say it's tech, or you could say it's pretty much everything. They have their hands in pretty much everything, from cloud to selling you some pharmaceuticals to selling you a t-shirt or toys. They pretty much, or groceries, they pretty much do it all. But these are the biggest names, and people are wondering, are they struggling? Well, let's pull up a chart on the CNBC Magnificent 7 Index, and you're going to see here that, I don't know if they're struggling, but they're sure has flattened out. Some might say, well, this is about to start maybe a downturn now. I would probably tell you maybe it's just consolidation, and now we're going to see the next leg higher coming up shortly. However you want to look at it, glass half full, glass half empty, I think the Mag 7 stocks are doing just fine. The Alphabets and the Amazons and they're doing just fine. And perhaps it's not so much that these names are struggling. Maybe it's because many other sectors of the market or other stocks are actually surging and maybe doing just as well or almost as well. Our next chart shows exactly that. More stocks are outperforming the S&P 500 in this year or over the last year than any time. 2025, you can see here, look how many stocks are outperforming the S&P 500. Over the last couple of years, we had very few stocks outperforming the S&P 500. They were mostly tech stocks that were leading. So you had, many eggs in one basket called technology. It's the biggest basket, makes up 40, 50%, depending on how you look at the S&P 500. And so maybe the Mag 7 aren't doing as bad as perhaps maybe some in the media are saying. And so I still believe you need to own some of these names. Own the names that make sense. Microsoft, for example, we've seen a decline in Microsoft stock from $450, $460 a share to $410. Maybe on a dip, you buy some Microsoft because it really hasn't done anything as of late. Maybe you don't look at a Meta because it's been on such a run. Maybe you look at Google, Alphabet, because it's had a bit of a pullback. So I think you want to continue to own the Mag 7, not all of them, but a few of them, especially for a diversified portfolio. To me, that continues to make a lot of sense. Don't get caught up on this idea, well, maybe the Mag 7 have had their day. I think their days are definitely still way ahead of them. I think many of these businesses will continue to benefit from artificial intelligence, from chips, from what is coming down the road in the future. And yes, there'll be more and more competition. But overall, I think if you continue to look at the Mag 7 as opportunity, I think that is the way you're going to continue to grow your portfolio. Choosing an investment advisor in general. And again, questions we get often here, people calling in, how do you find a good investment advisor? There are a lot of things to look through. But one of the things actually I tell people not to worry too much about are the letters behind the advisor's name. How many letters does somebody have? I have letters behind my name as an example. Are the letters important, or is the experience important? The advisor's knowledge, is that more important? And the answer to me is yes. An investment advisor that has their finger on the pulse of the markets, has a lot of experience, has been through many ups and downs, whether it's the tech bubble bursting, whether it's the financial crisis, whether it's higher interest rates, higher inflation, whether it's the quick little blips, like I mentioned, like the deep seeks, or whether it's, some of the European countries can't pay their debts. Whatever we've seen over the last 10, 20, well, let's say 26 years that I've been an investor, we've seen all these things. These all help. These situations all help make an investment advisor who they are today. And as I said off the top of the show, I find it interesting because just like buying a stock, you always want to buy best in class, right? The best names that you can. that makes sense, to have the best value, that can give you the best value. I think that's no different in finding an investment advisor. You want to find an advisor that sits on the top of the food chain, the top of that totem pole, that follows the markets extensively. And how do you know that advisor does that? Well, talk to them, ask them, do you follow the markets? How well do you follow the markets? You know, ask them what stocks they like today, what's going on with the stock market, why did it pull back, why has it surged higher? Get a feel for what they know. I have the pleasure on a regular basis and going on TV, on radio, or whether it's Canadian press or global news. I have the pleasure and the ability to do that, which is fantastic, and giving people information because I do follow the markets very closely. And there are many people like me that follow the markets closely that can talk to you about what's moving higher, what we believe is going to go higher or lower in the future. And that's who you want. You don't want to kind of trade down or move down the totem pole from an investment advisor that is in the wealth management area to someone who maybe only sells mutual funds or insurance or GICs or other interest-bearing investment ideas. You want to invest with someone or have someone by your side that has all the goodies in his briefcase to provide to you. Someone who can sell you a mutual fund or a stock, can build you a portfolio from scratch at any point in time based on what's happening today, not on what's happened over the last 6 months ago. Someone that can monitor those portfolios for change over time and be there to make those recommendations and talk to you on a frequent basis and be there to answer your questions. That is what you want in an investment advisor. And as I tell people quite often, ask questions about their strategy. What did they do in 2008? Were they even in the business in 2008 or during the tech bubble when it burst in 2000? That's how you find a good quality advisor. And that's what I would recommend to all of you watching today. If anyone who's looking for an advisor that does not have one, ask them what their process is. Ask them if they have a minimum amount. I personally don't have a minimum amount. I have clients that are big and small. If you want help, I am here to help. And I think that is what everybody should be looking for in an investment advisor. Quick hits, part of the show where we talk about 3 things that's been in the news that some of you may have seen. First one here, inflation impacting Canadian retirement planning. Inflation is starting to eat away at our retirement savings. We can price in 2% inflation when we do these retirement plans. We can now price in maybe 3% inflation might be a better number to price in these days. And obviously, the higher the inflation rate, the more it eats into your future value of your RSP or your investment. So we'll touch on that. MAGA policies showing up in corporate earnings results calls. MAGA, this is basically the Make America Great Again. We're hearing more and more, obviously, about the president talking about making America great again, having all his policies geared towards helping Americans, helping people in the United States. How's that affecting CEOs and their businesses? That is something we'll talk about in our second quick hit. Third one, RSP contributions declining as economic challenges cut into retirement savings plans. We're hearing that people aren't investing as much in their RSPs. I think for some, they're looking at other ideas like tax-free savings accounts. Now that those can be, you can, for the life of the plan, put up to $102,000 per person if you were above the age of 18 back in 2009. So we're seeing that more people are putting money in TFSAs, where the rules around TFSAs are a little looser. You can pull money out whenever you want. Whatever the money grows to, you don't pay any tax on it. But the only issue there is you don't get a tax deduction for contributing to a TFSA. RSPs, you do. So let's talk about our first quick hit, inflation impacting Canadian retirement planning. And we can show our first, well, I don't know if it's a chart, but our first illustration here. BMO Retirement Survey, over 3/4 of Canadians worry that they will not have enough retirement savings amid inflation. Canadians believe they need an average of $1.54 million for retirement. Roughly 2/3 say rising prices are affecting their ability to save for retirement. Annual registered retirement savings plan contributions reach record high of just under $7,500. And so this pretty much sums it up, right? says that on average, Canadians believe they need about $1.5 million to retire. I'm going to say I think it's just dependent on everyone, each themselves, meaning what your number or magic number is basically relative to you only. Someone else might have a different number. They might need more, they might need less. It'll depend on what lifestyle they need in retirement. But make no mistake about it, the Canadians are getting worried that because inflation has remained high for a little bit here, that it's definitely set them back a little bit with respect to their future retirement savings, what those retirement savings will look like. And so some Canadians may have to play catch up at some point in time down the road. Our second quick hit is one about the MAGA policy showing an uptick in corporate earnings calls. They're talking about things like tariffs. We have a chart here. How many times the word tariffs are being spoken about in corporate earnings calls? You can see here, this is a fascinating chart. You can see here back in 2019 and 20 and 2018, the Trump's first 4 years, how many times tariffs were mentioned in corporate earnings calls? Almost 500 times in 2018, 550 times in 2019. And you can see here in 2024, 175 times, and half of those mentions the word tariff happened in the last quarter, ramping up to the new Trump administration. You can already see in 2025, 191 times the word tariff has been mentioned in corporate earnings calls. Next chart, another fascinating chart, immigration. How many times immigration was mentioned? And you can see here also starting to move higher because as we know in the US, they're starting to talk about those that have come to the US illegally, sending them back to their place of origin. So MAGA, making America great again. This is something that, as I said earlier, CEOs are having to deal with, parse through, try to figure out as best they can. A lot of CEOs are taking more of a reactive role, which is what I've been telling investors with respect to investing. We can't try to be ahead of it because I don't even think the president knows what things will look like, a couple of months from now. So if he doesn't know, how are we supposed to know as investors and as CEOs of corporations? So MAGA, yes, it is definitely poking into a lot of CEO conference calls. Our third and last quick hit is this one about RSP contributions declining for Canadians. And we have that illustration here as well. 39% of Canadians plan to contribute to their RSP this year. Sharp 10-point drop from 2024 figures. 15% plan to contribute their maximum amount to RSP, a drop of 6 points from the previous year. Young Canadians 18 to 34 experiencing a notable decline with just 41% planning to contribute, down 60% from the previous year. And 1 in 10 Canadians indicate they can't afford to invest in RSPs at all. And again, as I said, especially with the younger group, the younger generation, I think TFSAs is definitely taking a bite out of perhaps their RSP contributions, people moving money for now into TFSAs. And I recommend that. If you need an RSP deduction for income tax purposes, March 3rd coming up is the deadline for 2024 income tax. But if you don't need a tax deduction, TFSAs is definitely the way to go. So I'm not so concerned that people may not be contributing as much to RSPs as long as they're contributing to their TFSAs or other investment ideas, because I think over the long term, you want to maintain that momentum. You always want to put away money for your future and some savings for a rainy day. So very, very important. And to see some of these numbers pull back, I guess it's going to depend on the exact reasons why that is. Now the part of the show where I try to take at least one question from our audience. We had a question regarding gold that came in over the last week, I believe. It says, what are your thoughts on gold? Is it a safer investment with all of the unpredictability coming out of the White House? My take, as many of you know that watch the show, I'm not much of a gold bug. And for me to see something go higher because of the demise of something else. So gold moves higher when the U.S. economy struggles, when the U.S. dollar struggles, usually, or when there's now chaos in the world. We don't know what's going to happen with the tariffs and what's going on with potential trade wars between the United States and really most of the other parts of the world, whether it be Europe, Asia, China in particular, Canada, Mexico. There's a lot of uncertainty out there, and I think gold has definitely reaped the reward of it. A lot of people are talking about gold going over $3,000 an ounce, and my take is yes, I think it can get there, but I don't know if I would call it a safer investment as this person asks. I never want to say anything is safe if you could see something move as quickly as gold. I've seen gold move up and down 50, $100 an ounce in the span of an hour. Is that a safe, quote unquote, safe investment? I guess it just depends on what people call safe. Maybe you want to have a little piece of gold as part of a diverse portfolio, but I definitely wouldn't want to make it a major part of a diverse portfolio, or at least the core part of a portfolio. So with that, I want to thank everybody for joining me this afternoon. As always, I hope that you took at least something, one thing, hopefully more than one thing, but at least one thing from our show today. We tried to answer as many of your questions that we've been receiving over the last couple of weeks. I hope we were successful in doing that. And I want to tell everybody that we will be back as always 2 weeks from now on March the 5th. I can't believe it. We're already going to be in March next time we broadcast. Same time, same place. And until then, happy investing.